If you are a Canadian senior and you have money in an RRSP, a RRIF, or savings sitting in a bank account, there are changes happening right now in 2026 that directly affect how you access that money, how much of it the government is entitled to take back, and what steps you can take today to keep more of what you have earned. The rules around cash transactions, RRIF withdrawals, and the OAS clawback are shifting in ways that most seniors have not been clearly told about. Tonight we go through all of it: what is actually happening, what is confirmed, what is still proposed, and what you can do right now to protect your income and your financial independence. Let us start with the cash and banking rules, because this is where the most confusion is circulating and where the facts matter most. In 2025, the federal government introduced legislation known as the Strong Borders Act, which included sweeping changes to Canada's anti-money laundering framework. The changes that most directly affect Canadian seniors involve cash transactions at banks and other financial institutions. Under the legislation, it is an offense for any business or charitable organization to accept a cash payment of $10,000 or more in a single transaction or related series of transactions. A related proposed regulation goes further, proposing a blanket prohibition on third-party cash deposits, meaning someone other than the account holder depositing cash into your account at a bank branch, regardless of the amount involved, with limited exceptions. It is important to be precise about where these rules stand right now. The $10,000 business threshold is law. The third-party cash deposit prohibition is still a proposed regulation, and final details are still being determined. The direction of travel is clear, but the specific rules governing third-party deposits have not yet been finalized as of April 2026. If you rely on a family member to deposit cash into your account on your behalf, this is something to monitor closely and to discuss with your bank directly. What is confirmed and already in effect is the existing FINTRAC framework, which has been in place for years and has now been strengthened with dramatically higher penalties. Any single cash transaction of $10,000 or more is automatically reported to FINTRAC, Canada's financial intelligence regulator, within 15 calendar days. No notification to you is required, no consent is needed. The report is filed automatically every time without exception. The 24-hour aggregation rule is also in effect. If you make 2 or more separate cash transactions that together total $10,000 or more within any single 24-hour period, FINTRAC treats them as one combined transaction and a report is filed. 2 deposits of $5,500 on the same day equal $11,000 in FINTRAC's system. The report is automatic, and deliberately breaking up transactions to stay below the $10,000 threshold. For example, making repeated withdrawals of $9,500 or $9,800 specifically to avoid the reporting requirement is called structuring. It is a criminal offense under Canadian law, regardless of whether the money involved is entirely legitimate. Even if every dollar came from your pension, even if you saved it over decades of honest work, structuring is illegal. Do not do it. The penalties that financial institutions now face for non-compliance with these reporting rules have increased significantly. Fines can now reach $20 million or 3% of a bank's global revenue per violation. For Canada's largest institutions, 3% of global revenue is a number measured in billions. The practical consequence is that banks have upgraded their compliance systems, retrained their staff, and their compliance officers are now more cautious than at any previous point in Canadian history. An unexplained large cash deposit from an account that normally only receives monthly Service Canada direct deposits will trigger a review. The senior depositing the money may have done absolutely nothing wrong, but the disruption, the hold on funds, the documentation requests, and the waiting period are real and can cause genuine hardship for someone depending on that money to pay rent or buy medication. The protection against this disruption is straightforward. Keep a written record of cash you set aside, a simple notebook with dates, amounts, and the source of the money. Organize any supporting documents before a large deposit, bank withdrawal records, a sale agreement, and estate letter, and call your bank branch before making any large cash deposit. Tell them in advance what you are planning to deposit, where the money came from, and that you have documentation ready. This one phone call can reduce a 2-week compliance review to 2 or 3 days. Banks treat proactive, transparent customers very differently from unexpected large cash deposits at a teller window. Now let us talk about the RRIF rules, because this is the issue that affects hundreds of thousands of Canadian seniors in a direct and often painful way, and it is not getting enough clear attention. If you have an RRSP and you are turning 71 this year, you face a hard and irreversible deadline. By December 31st of the year you turn 71, your RRSP must be converted into a Registered Retirement Income Fund, a RRIF, or used to purchase an annuity. Once your RRSP becomes a RRIF, the government requires you to begin withdrawing a minimum amount every single year for the rest of your life, whether you need the money or not. The minimum withdrawal percentages increase with age, and they were set by the government based on assumptions about investment returns and life expectancy that were established decades ago. At age 71, the prescribed annual minimum withdrawal rate from a RRIF is 5.28% of the account's value. By age 80, that rate rises to 6.82%. By age 90, it reaches 11.92%. Life expectancy in Canada reached 83.26 years in 2025, and data shows that 14% of Canadians will live to age 95, a dramatic increase from just 5.6% in the 1980s. The government's withdrawal formula was built for a world where most people did not live this long. The longer you live, the more the mandatory withdrawal schedule drains your account in the later years of retirement when you may need it most. Every dollar you are required to withdraw from your RRIF is fully taxable income. It counts toward your total annual income, which the Canada Revenue Agency then uses to determine your entitlement to old age security. This is where the RRIF and the OAS clawback collide, and the collision is one of the most commonly misunderstood financial pressures facing Canadian seniors today. The OAS clawback, formerly called the OAS recovery tax, begins when your net world income exceeds $93,454 for the benefit year running from July 2026 through June 2027, based on your 2025 income. For every dollar of net income above that threshold, 15 cents is recovered from your OAS through your income tax return. OAS is fully eliminated for seniors aged 65 to 74, whose income exceeds approximately $154,000. For seniors 75 and older, the full elimination threshold is slightly higher. You do not need to have a high income for this to matter. A modest retiree living on CPP, OAS, and RRIF withdrawals can be pushed over the clawback threshold by a single unexpected event: the sale of a property, a one-time inheritance, a spike in investment distributions. When that happens, the OAS reduction follows automatically. There is no warning letter. There is just a smaller deposit in the following year. Many seniors discover this only after it has already happened. The interaction between mandatory RRIF withdrawals and the OAS clawback is one of the strongest arguments for planning your RRSP drawdown strategy well before you turn 71. Canadians who are in a lower tax bracket in the years between 65 and 71, before CPP and OAS are both fully flowing, have an opportunity to take voluntary withdrawals from their RRSP and pay tax at a lower marginal rate during those years. By reducing the RRSP balance before it converts to a RRIF, you reduce the mandatory annual minimum that will be required later, which means less forced taxable income, a lower risk of triggering the OAS clawback, and more flexibility in managing your finances across retirement. This strategy requires advanced planning. The window for implementing it closes when your RRSP converts at age 71. If you are approaching that age and have not yet spoken with a financial planner about your drawdown strategy, that conversation is worth having now. There is also a one-time election available before your first RRIF payment is issued. If your spouse is younger than you can elect to use your spouse's age rather than your own to calculate your annual minimum withdrawal. This lowers the percentage you are required to withdraw each year and can meaningfully extend how long your RRIF lasts. This election must be made before your first RRIF payment is processed. Once that first payment goes out, the option is gone permanently. Any RRIF withdrawals you receive that exceed your actual living needs can be redirected into a tax-free savings account rather than sitting in a regular savings account. The TFSA is one of the most powerful financial tools available to Canadian seniors in the current environment, because withdrawals from a TFSA do not count as income. They will never trigger the OAS clawback, regardless of how large they are. If you are receiving more from your RRF than you need to live on, moving the surplus into a TFSA protects your OAS and allows that money to continue growing tax-free. Over the course of a retirement, this difference can be worth thousands of dollars. Let us now give you the confirmed April 2026 benefit amounts for CPP, OAS, and GIS. Canada Pension Plan increased by 2% effective January 2026. That rate holds through December. The maximum monthly CPP retirement pension for someone who began benefits at age 65 is $1,575. The average monthly CPP for new beneficiaries in the current quarter is $925.35. Your personal amount depends on how much and how long you contributed. Starting before 65 permanently reduces your payment by 0.6% for every month before your 65th birthday. Delaying past 65 increases it by 0.7% per month, up to a maximum gain of 42% at age 70. Old age security. The April to June 2026 quarter saw a 0.1% increase, bringing the cumulative annual increase from April 2025 to 2.1%. The maximum OAS for seniors age 65 to 74 is $743.05 per month. For seniors 75 and older, the maximum is $817.36, reflecting the permanent 10% enhancement introduced in July 2022. OAS is protected against deflation. It can increase with inflation, but it will never decrease even if the consumer price index falls. Guaranteed income supplement. The maximum monthly GIS for a single senior in the April to June 2026 quarter is $1,985 on top of OAS. GIS is entirely non-taxable and does not count toward the OAS clawback income calculation. A single low-income senior receiving full OAS and maximum GIS receives a combined total of $2,728.05 every month before any CPP. GIS eligibility is recalculated every July based on your previous year's tax return. If your 2025 income tax return is not filed by April 30th, your GIS payments can be suspended in July until Service Canada receives your income information. The April 30th deadline is critical for every senior receiving or eligible for GIS. File now if you have not already. Call the CRA at 1-800-959-8281 or visit canada.ca to find a free tax clinic near you. There is a dimension of these changes that deserves direct and honest discussion, because it speaks to something deeper than any single rule or regulation: the question of financial autonomy for older Canadians. For decades, cash served a genuine and important function for seniors in ways that digital banking does not fully replace. Cash provides a hard budget. You can only spend what you have on hand. For seniors managing fixed incomes, this is not a preference. It is a discipline that has kept household finances stable for a lifetime. Many Canadians in their 70s and 80s did not grow up with digital banking, are not comfortable with e-transfers and banking apps, and built their financial lives around the physical reality of cash in a wallet or an envelope in a drawer. The new restrictions being introduced through anti-money laundering legislation do not affect everyone equally. They fall most heavily on those who are least able to adapt to digital alternatives, and that population is disproportionately older Canadians. This is not an argument against financial regulation. Money laundering and fraud cause real harm, including to seniors. The same banking compliance systems that create friction for legitimate cash deposits are the systems that protect seniors from financial crimes. They are the systems that stopped a grandmother in Saskatoon from wiring $11,000 to a scammer posing as a CRA officer. The rules serve a real purpose. But honest acknowledgement of that purpose does not require pretending that the transition costs are zero. For seniors in rural communities who drive 45 minutes to the nearest bank branch and pay tradespeople in cash because that is how local services have always worked, These changes create real friction. For elderly couples who have always given cash gifts to grandchildren because it feels personal and meaningful, new third-party deposit restrictions create unfamiliar barriers. For widows and widowers who were taught by a generation that survived uncertainty to keep emergency cash at home, the advice to move everything into digital systems is not simply a technical upgrade. It asks for a change in a lifelong relationship with money. Acknowledging these costs is not alarmism, it is honesty. And the practical response to those costs is not panic, it is preparation. Knowing the rules clearly, building a simple paper trail for cash that is saved at home, having a proactive conversation with your bank before making a large deposit, and understanding what documentation protects you. These are the steps that preserve your financial dignity and your access to your own money within the new framework. Advocacy also matters. Organizations that represent retired Canadians have argued consistently that seniors should have meaningful input into how financial regulations that directly affect them are designed and implemented. If you believe the rules around cash and banking are moving in a direction that does not account for the needs of older Canadians, that voice matters. It can be expressed through formal consultations, through the organizations that represent you, and through your elected representatives at the federal level. The financial environment for Canadian seniors in 2026 is more complex than it has been at any previous point. The rules around cash have tightened. The RRIF withdrawal schedule was built for a shorter lifespan than the one most Canadians now have. The OAS clawback catches seniors who have no idea it is coming. These are real challenges that deserve real, clear information, not alarm, not vague warnings, and not silence. What you have earned over a lifetime of work belongs to you. Understanding the rules that govern how you access it, how it is taxed, and how to protect as much of it as possible is not just practical. It is your right as a Canadian senior. Let us close with the practical steps that matter most right now. Regarding cash, keep a simple written log of any cash you set aside, including the date, amount, and source. Organize supporting documents before making any large cash deposit. Call your bank in advance of any large deposit and explain the source proactively. Never deliberately break up transactions to avoid the $10,000 reporting threshold. That is structuring, and it is a criminal offense. Regarding your RRIF, if you are approaching age 71, speak with a financial planner before your RRSP converts. Explore whether voluntary early withdrawals make sense for your tax situation. Consider the spousal age election for minimum withdrawal calculations if your spouse is younger. Direct surplus RRIF income into your TFSA rather than a regular savings account. Regarding OAS, understand the clawback threshold for 2026, $93,454 in net world income. Know what events could push you above it. Work with a tax professional if you are approaching that level to understand what options exist to manage your reportable income. Regarding your tax return, file your 2025 return before April 30th. File even if you have no income. File even if you owe nothing. Your GIS, your GST credit, and access to other income-tested benefits all depend on it. These changes are real and they are ongoing. The rules around cash, RRIF withdrawals, and the OAS clawback will continue to evolve. The seniors who navigate this environment best are not the ones who have the most money. They are the ones who have the most accurate information and act on it before a problem arrives rather than after. The specific details of proposed regulations, particularly the third-party cash deposit prohibition, are still being finalized. This means the landscape could shift further in the coming months. Checking in with your bank, your financial planner, and trusted information sources on a regular basis is not overcaution. It is the practical minimum for protecting yourself in an environment where the rules are actively changing. Do not rely on what was true 6 months ago. Verify what is true today. Leave your question in the comments below. Every comment is read and responses are given. If today's conversation helped you understand something that was unclear before, please share it with a senior in your life who deserves the same clarity. Subscribe and turn on notifications to receive accurate, plain language updates whenever the rules change, whenever benefit amounts are confirmed, and whenever anything shifts that affects your income or your financial independence. This is Canada Pension Vault.